Welcome back to the Noob Selling Options channel. Listen, I am absolutely thrilled to have you here for today's explainer. We're going to be diving into some seriously incredible recent wins we've had in the market, but more importantly, we're going to unpack the hidden dangers that are lurking right beneath the surface of this massive bull market. I mean, if you're selling options right now, you know exactly how good it feels to just print cash week after week. But what happens when the music stops? Today, we are mapping out exactly how to survive the inevitable high-yield trap. So let's just dive right in.
Just let that number sink in for a second. $1,076. This right here is what we are celebrating today. We went into week 4 with our standard, totally respectable weekly target of $500 in premium, and we absolutely shattered it. Clearing over $1,000 in a single week using our options engine? Yeah, that is what I call a very good problem to have. But, hitting over double our target naturally begs a pretty big question. Are we just getting lucky here, or are we structurally exposed to a massive pullback?
So here is exactly how we're going to break it all down today. First up, smashing the weekly target. Second, the week 4 premium breakdown. Third, the mechanics of high yield. Fourth, the anatomy of a trap. Fifth, the market correction cycle. And finally, number 6, building your volatility reserve. All right, let's kick things off with section 1, smashing the weekly target, and how we completely cleared that $500 goal. Now, what's genuinely fascinating about our data for week 4, ending July 17th, 2026, is the sheer variety of it all. We are actively managing 9 different contracts across 6 different tickers. We've got Microsoft, DRAM, IREN, CRCL, Palantir, ServiceNow, and Sophie. I know, it's a super busy board, but every single one of these plays contributed to that massive $1,076 total. It's basically our wheel and barbell strategies firing on all cylinders. But to really wrap our heads around how we built this monster yield, we need to categorize these trades. Which brings us right into section 2, the week 4 premium breakdown, the actual source of that $1,076. This is where the beauty of balance really shines through. We have a nearly 50-50 split in our yield, which is absolutely fantastic for risk management. First up, our cash-secured puts are doing the heavy lifting when it comes to efficiency. With just 3 contracts, we pulled in the majority of the cash, $568. Now remember, we're locked in to buy these shares if they drop below our strike prices by next Friday. Then to balance it out, our covered calls generated $508 across 6 contracts. That's the yield we're generating on our existing equity positions. It really is a beautifully balanced engine right now. But when we start digging into the specific tickers, well, the story gets a bit more aggressive. Over 60% of our entire premium haul comes from just 2 highly volatile tech tickers. First, we have this very active strangle setup on CRCL. We sold a $65 cash-secured put for a whopping $251 and paired it with a $75 covered call for $59. That tight $10 window netted us $310. Add in our double IREN calls at the $44 strike, which brought in $171 each, totaling $342, and suddenly you realize that $652 of our income is riding entirely on these high beta heavy hitters. So the absolutely crucial point here is that we must balance out those wild crypto and high beta plays. We can't just run naked into volatility. We do that with our stable anchors. We've got Microsoft bringing in a very strong $191, then we have ServiceNow tossing in $56, and Palantir acting as this nice out-of-the-money buffer yield for $31. These are our foundational yields, right? They lower our overall portfolio volatility while still chipping in really solidly to our weekly cash flow. Okay, now that we've seen the what, let's explore the why in section 3, the mechanics of high yield, why premiums are soaring. It all really comes down to the specific environment we're trading in right now. First off, the market is pricing in massive expected moves for our high beta and crypto exposure. That means implied volatility, or IV, is just through the roof. Buyers are literally willing to overpay for these contracts. But the real secret sauce here? The upward momentum advantage. In a rising market, we can aggressively sell out-of-the-money covered calls and at-the-money cash-secured puts without ever getting tested. Because our shares aren't getting called away and our puts aren't being assigned into underwater stock, we just continuously roll these contracts week after week, capturing these inflated premiums. Honestly, it kind of feels like free money. But we do need to get serious for a moment as we transition to section 4, the anatomy of a trap. What happens when that upward momentum ends? Right now, our positions aren't trapped, but we have to understand the mechanical breakdown of what a trap actually looks like. Let's look at the first scenario, the put trap. Imagine CRCL plunges well below our $65 strike. Suddenly, boom, we're assigned.
We are forced to buy 100 shares at 65 bucks. The trap here is that our liquid cash collateral is totally gone. It's tied up completely in equity that is currently trading at a loss. We can't just sell easy cash secured puts anymore. So naturally, we try to spin the wheel and move to the second scenario, the call trap. We start selling covered calls on our shiny new CRCL shares to make some income. But what if the stock keeps falling down to, say, $45? We have a huge problem. If we try to sell a call at our $65 break-even, the premium is going to be virtually $0 because it is so far out of the money. The trap really springs when you get greedy. If you drop your strike down to $50 just to collect some kind of premium and the market suddenly rebounds, your shares get called away at $50. You are forced to realize a permanent $15 per share capital loss. That, my friends, is the anatomy of the trap.
Understanding those brutal mechanics brings us perfectly into Section 5, the market correction cycle, the 3 phases. Let's walk through the actual timeline of a failing high-yield engine so you aren't caught off guard when it happens. Phase 1 is what I call the illusion. As a correction begins, fear floods the broader market and IV skyrockets. For a very brief, dangerous window, the premiums on your puts are going to look juicier than ever. You will honestly feel like a genius. But then comes Phase 2, the avalanche. The downturn sustains itself, those puts go deep in the money, and suddenly you face mass assignment across multiple tickers all at once. Your cash completely dries up as you are forced to buy the stock. Finally, you enter Phase 3, the drought. With your capital locked in underwater shares, you have to sell covered calls at or above your cost basis just to protect yourself. But because the stock is so depressed, those premiums shrink to literal pennies. Your weekly income will plummet from over $1,000 down to maybe $100 or $200. You are going to miss your $500 target for weeks, maybe even months. So, the million-dollar question, how do we survive? Let's move to our final section, Section 6, building your volatility reserve, surviving the drought. It is absolutely vital to let this core concept sink in. When we make $1,076 instead of our standard $500 target, that extra $576 is not free money. It's not bonus cash for a weekend vacation. It is literally the market paying you in advance to compensate for the dry spell that is absolutely guaranteed to come during a correction. Because we run a barbell framework, we have to treat this excess premium as a volatility reserve. Keeping a portion of these wildly inflated premiums in cash or high-yield liquid reserves ensures that when we finally do hit Phase 3, your lifestyle cash flow remains completely uninterrupted. Which brings me to a final, provocative thought to leave you with today. I want you to take a hard look at your own portfolio right now. Are you keeping dry powder, or are you aggressively compounding every single cent back into new positions at the very top of the market? Let me know your specific cash management strategy in the comments down below. I literally read every single one of them. And hey, if you found this explainer valuable and you want to keep surviving and thriving in the options market with us, make sure to smash that like button and subscribe to the Noob Selling Options channel. We have a ton more survival guides and weekly breakdowns coming your way. Until next time, trade smart, manage your risk, and I will see you in the next one.